Here is an uncomfortable fact about the bank holding your money. It cannot give everyone their money back. Not because it is failing or dishonest, but by design. If every customer walked in tomorrow and asked for their deposits at once, no ordinary bank on earth could pay them all. And it is not supposed to be able to. Banking works only because we never all ask at the same time. The reason sits in what a bank actually does with your deposit. It does not lock it in a vault. It lends most of it out to homebuyers, to businesses, keeping only a small fraction on hand for the trickle of people who withdraw on a normal day. Your money is, right now, mostly somewhere else, doing something else, in someone else's hands. Which means a bank is a strange kind of promise. It owes everyone their money on demand, yet it has lent that money out for years. On any calm day, this mismatch is invisible and harmless. But it leaves every bank quietly dependent on one thing above all others, that its customers stay calm. And this is the part I find genuinely gripping, because it means a bank's health is not purely a matter of its accounts. It is a matter of belief. A perfectly sound bank and a failing one can look identical the morning a rumor starts. What decides which one survives is not always the numbers. It is whether people believe. Watch how it unravels. A whisper spreads that a bank is in trouble. A few nervous customers rush to withdraw. Others see the queue forming and think, better safe than sorry. So they withdraw too. The bank, to pay them, must sell its loans at a loss, which weakens it, which makes the rumor look true. Fear becomes the cause of the very collapse it feared. That is a bank run, and it can destroy a healthy bank in days. This is not just theory. For a century and more, bank runs did exactly this. In waves, healthy and unhealthy banks alike collapsing not from bad loans, but from frightened crowds. In the Great Depression, thousands of banks fell this way, each panic feeding the next, wiping out ordinary people's savings, simply because everyone tried to be the first one out the door. So governments reach for an ingenious solution, one that works not on the banks but on your mind. They promise that if a bank fails, the government itself will refund your deposit up to a generous limit. And the magic is this: once you truly believe your money is safe no matter what, you have no reason at all to run. The guarantee mostly never has to be used, because it removes the fear that would trigger it. Which reveals the strangest thing about the whole system. Deposit insurance is not really a great pile of money waiting to repay everyone. It could never cover every deposit at once. It is a confidence machine. Its true product is belief. It prevents runs precisely by making them pointless to start, and so the money almost never actually has to appear. But belief can still crack faster than any backstock can act, and when it does, it is breathtaking. In recent years, a large bank collapsed in barely more than a day, as customers, warned by messages on their phones, pulled billions of dollars out in a matter of hours. The oldest fragility in banking, now running on modern rails. And the lesson held exactly. A bank is only ever as solvent as its depositors believe it to be. Which is the quiet truth beneath all the marble and the walls. A bank is not a fortress stuffed with your money. It is a promise kept aloft by collective confidence and propped up by a government guarantee whose main job is to keep that confidence from ever breaking. Solidity, it turns out, is a state of mind. So the next time you deposit your money without a second thought, notice the thing you are really relying on. Not a vault, not a stack of your cash, but a shared belief, yours and everyone else's, that the money will be there when you ask for it. A bank is solvent only as long as you believe it is. The belief, in the end, is the product.